Hi, I am Professor Milligan. Welcome to my weekly series, Wall Street Wednesdays. I record this series live every Wednesday from 1 to 2 p.m. Pacific Standard Time on my Instagram account at Professor Milligan. Welcome to join me there or listen to the recording here. Enjoy. Thanks. It is June 24th, and this is Wall Street Wednesday. Let's get started. As I said, welcome to Wall Street Wednesday. So this is Wall Street Wednesday. I'm Professor Milligan. And as you guys know, I'm looking now at the market in the closing. It looks like, well, I haven't got the official number yet here. Looks like we closed down 709 points. We're down for the week. We're also taking back all the gains for June. One of the things that I look at in the marketplace, and one of the things that the Wall Street looks at, which is where I got it from, is the 200-day moving average. And Wall Street uses a 200-day moving average to determine whether a stock or the market is in a bull market or bear market. So the 200-day moving average is nothing more, for those who don't understand. They're going to take all the prices for the last 200 days, divide that by 200, and get an average. And then as we move forward each day, the last 200th day, which 201st day, will drop off and a new day will be added. 20 days is a month. So 200 days is over the last 10 months, what has the market done? If the market or a security is above its 200-day moving average, it's considered to be in a bullish market and everything's fine. If it's trading below its 200-day moving average, the market considers it to be in a bearish market and headed down. Right now, the market itself is sitting right at its 200-day moving average. The Dow Jones, I just checked again, is sitting at its 200-day moving average. It's sitting right above it. The other thing that I noticed in the marketplace is that a lot of the stocks and the market itself are either in what we call a descending right triangle, which is bearish. Descending. So descending right triangle, what it means is lower highs and lower lows, but there's a base at support. And that right triangle, which is going to be on the bottom left-hand side of the chart, means that this is a bearish signal. Now, I'm not saying we're going down from here. I don't know if this is it. But again, a lot of stocks are trading in a what we call a descending right triangle, which is a bearish triangle. The other thing, too, the stocks that are not in a descending right triangle, the majority of them are in a trading range. A trading range is a difference between the high and a low. Trading range. This is the low, this is the high. And you'll see the security come down and hit the low, trade up and hit the high, but stay within that range. At some point, the market, the security itself, will either push through that resistance and go to a new high or go to a high, or break through support and go lower. But right now we're in a trading range. So what I tell students, which I'm telling you guys, is when it hits this high price, the bears step in and short it and move it back down. When it hits the low price, the bulls step in, buy it, and push it back up. Hits the high price, they stop buying, selling comes in, pushes it back down. All right, that's a trading range. The strength of a trading range depends upon how strong support and resistance is. Now, I'm not trying to get into too much technical analysis here, but I think you need to understand this. The analogy I'm going to give you for support, base, resistance, top, is a house, is a roof. The floor is support, all right? Every time you jump or come down on that floor, it's built, it's strong, it holds you and supports. If that floor is weak, if that floor is not built correctly or standard, or if the security or the asset itself comes down with so much force, it could actually break that floor, go through it, and might go to another floor. That's what we call support. Now, one of the ways that we can measure support is how much institutional buying, how much volume was there at the support level. So again, when you hear them say a stock is trading or the market's at support, it means that we've come down to the floor and we're going to see if the market holds. If the market holds and goes higher, then we're going to say, wow, this is bullish, it's good. If the market doesn't hold, this support doesn't hold, it goes below that, you'll see it trade down to the next support level, and hopefully it'll hold there. If it doesn't hold there, it'll go down to the next support level. This is what they call about support. Now resistance. So we're talking about support and resistance in technical analysis. So resistance is your ceiling. Now, as you guys know, if I told you right now to stand here and punch through your ceiling, how much effort it would take for you to jump and punch. You could actually get some materials and push through, but you understand the effort it would take to push through that ceiling. That's the reason why I tell you, when it breaks through resistance, you want to see it break through on volume. Because if that volume comes through and it breaks through, it'll give it a bigger push all the way up. If it doesn't get that volume behind it, it might push through it and then not hold. If it pushes through, and once it pushes through this resistance level, the next ceiling becomes resistance level. If there's no ceiling, we don't know where resistance is going to show up. If it pushes through hard enough through this resistance now becomes the floor, support. I hope all this is making sense for you guys. So what I'm saying right now is a lot of these securities, I went and checked, I look at these stocks, I look at this charts, the technical analysis. A lot of securities right now are at support level. And for the last week and a half, they've been trading in a trading range between support and resistance. If it breaks support, it's going lower. If it breaks resistance, you think it's going to go higher. All right, that's what we're looking at. That's what I see with the market. So the next day or two, a couple of days, is going to be really key to see if this market holds its support level. And also if your securities hold their support level. A lot of securities that, the easy money was already made. Now it becomes to see who actually knows what they're doing, who's out there and has an idea and has a plan. No one knows what this market's going to do. We're in a trading range. The only thing I can say to you in terms of the market itself, if you're a long-term investor, go ahead and nibble. You nibble on weakness and just keep holding. If you're a short-term trader, you got to be nimble. You just got to be, guys. And the other thing which is also coming up, you're seeing a lot of what we call a gap on the opening. A gap on the opening means that if the market's up 400 points, a gap's up 400 points and then trade sideways from there. If it's a gap to the downside, it'll open up down 400 points and trade up and down, but basically trade sideways from there. So you're getting most of your moves in these markets before the market opens. All right, it's very rare. And in a bullish or bearish, straight bullish or bearish market where where the market has made a decision on whether it's bullish or bearish, you don't see this. You'll either see it push higher or push lower. You don't see what we're seeing in terms of this trading. It's a very interesting and very different market. So that's where we're at. Now I had a question come through, and again, I remind you guys, you can always hit me up on Instagram with a question. If you have any questions or concerns, hit me up. So I did have a question come through, and the question asked was, what indicators do I look at? With that, let me put it this way. I don't look at many indicators. I believe that if you watch the market will talk to you and tell you what to do. Now, the indicators I do look at, and my students have heard me say it all the time and they know it, I'm more concerned with, when I look at the indicators, if the market is in a bullish market or bearish market. I'm not trying to time the market. I'm not trying to time when to get in and when to get out. What I'm looking at is, I'm looking to see if the market itself, overall market, is going up or going down. In a rising tide, all ships go up. In a bullish market, almost all stocks rise. In a low tide, all ships go down. In a bearish market, almost all stocks go down. There's always exceptions. So I'm more concerned with whether we're in a bullish market or bearish market. And if we're in a bullish market, I want to be long. And if I'm in a bearish market, I'm going to get short. What do I look at? I look at leading indicators. So one of the main leading indicators I look at is called the yield curve. Shortly put, the yield curve shows where interest rates are at for the short term, intermediate term, and long term. Short-term is money short-term money is money market funds, corporate cash, cash that corporations use. Intermediate is anywhere from 5 to 10 years, and long-term is 20 or 30 years. In the long end, a yield curve looks at the interest rates for the different maturities. Now, I don't want to get into too much of the yield curve right now. I just don't have the time. I have many of my students here who know I have a passion and I talk about the yield curve, and the yield curve right now is batting 100%. So I'm going with the yield curve, but it is a leading indicator. What the yield curve basically is, it's what they call the unbiased expectation theory. And that theory basically states when short-term rates are low, and right now short-term rates are between 0 and 25 basis points. 25 basis points, which is nothing more than 1/4%. So when short-term rates are down here, this is considered to be bullish for the economy. But with short-term rates, what happens is you eventually expect the Fed to raise short-term rates to fight inflation. And if the Fed starts to raise short-term rates and short-term rates rise and long-term rates go down, we get what's called as an inverted yield curve. In my lifetime, every inverted yield curve has led to a recession. Just that simple. The last inverted yield curve we had was a year and a half ago. So again, inverted yield curves give you 6, 12, 18 months lead time to figure out what's going on with the market. That's one that I look at. The second thing I look at, which I kind of talked about already, I look at the 200-day moving average just to see where the market's overall at. And as it makes sense right now, the market is trading right at its 200-day moving average, which is pretty much expected. Not sure which way we're going yet. I also look at unemployment. So the one thing I look at is unemployment. Our economy, consumers are our economy. The consumers make this thing go. So I also look at unemployment. And yes, we become more efficient. Yes, we can function with a number of Americans unemployed because of the technology that we have. But the bottom line is this: when we as consumers have more cash in our pocket, we spend that cash. And when you spend that cash, you spend it and corporate America gets it. And that's what drives the value of these businesses. If you and I have less money as a group, and one of the ways we have less money is by having high unemployment. The other way is if they raise taxes. But anyway, by having high unemployment because of the coronavirus, there's less people working. That means there's less cash as a group aggregate. Now, don't get me wrong. We have some wealthy individuals who've actually become more wealthy. But again, the average consumer is fighting to keep their job. The average consumer is hoarding cash. All that to say, those are the things I look at. The last thing I look at is the stock market. The stock market's a leading indicator. Investors typically buy because of what they think where the market's going to be 6 months to a year from now. Based upon this scenario, I'm getting conflicting signals. I've got my yield curve, which gave me my recession, which I believe we're already in a recession. I'm looking at this high unemployment. I'm hearing that the coronavirus is not gone. The cases are actually getting higher and bigger. I don't think that any state or local government or state has or wants to close down their economy again because it would actually be detrimental. But there are some issues going forward with that. So there's a disconnect between the market and the economy. So again, I try and narrow my indicators down to 2 or 3. I'm not looking for a whole bunch of indicators. And the reason being is it's very rare that you'll get all 10 indicators giving you a buy or sell signal at one time. So I tried to narrow it down, and I did narrow it down to 2 or 3 indicators that I look at. Another important thing I want to bring up is, and I'm going to post something briefly about this on Instagram, but one of the things I want to bring up, if you guys are actively trading, which investing, trading, doesn't matter what you're doing, you must keep a journal. Let me repeat this. You must keep a journal. Without keeping a journal, you have no idea why you made money or why you lost money. I know journals can be, I don't want to say they're hard. It's just time consuming to sit down and write, but you got to write down your thoughts. You got to write down a couple things. Keep a journal. 1, why'd you make the trade in the first place? What did you see that led you to believe that you would make money in this security or whatever it is you're doing, whether you're going long or short? So 1, why'd you put the trade on? 2, and all this is based on why. You got to think this through. When you close out the position, sell the stock, cover the short, whatever it is that you do, when you close it out, next question, did you make money or did you lose money? And then why did you make money or why did you lose money? You must write this down. You must think this through. And the reason being is if you don't know why you lost money, you're doomed to repeat it over and over again because you have no idea why you lost money. Not every trade's going to work, even when you're right, but you need to know why. The other thing is, why did you make money? And you can put down, it was just dumb luck. If that's the case, so be it. But you got to write down why you made money and how you made money. And the reason why you're doing that is because you want to be able to repeat the process. It's really simple. You're writing down what worked and what didn't work so you can repeat the process. My students have heard this story. I'm going to tell this story. You're looking at a young Mike Milligan running a hedge fund on Wall Street. One weekend I came home, my wife and I, we were living in Jersey City at the time, came home and I had in front of me every trade I had done for the last 6 months. Every trade. It was a stack of papers. I literally walked into my living room and laid out every trade that I did. And I went through every trade and asked the question, why did I do it? Did I make money? Did I lose money? When everything was done, at that point, I had 3 strategies I was using to trade. 3 distinctly different strategies. One strategy, when I was right, I made 1/8 of a point. And I was taking down blocks at 10,000 shares. 1/8 of a point on 10,000 shares is $1,250. All right, so that's what I was making. I made 1/8 of a point. When I was wrong, I was losing 3/8 of a point. So I was losing anywhere from 1/4 to 3/8, which means I was losing twice as much, in some cases 3 times as much as I was when I was right. And the other challenge was I was only right about 50% of the time. So when I went through and I looked at that, and I looked at every trade I did, I said, if I had not done any of these trades, my account would be up substantially from where it was. So I never did that trade ever again. I found another strategy I was using was right about 75% of the time, and I was making $2 to $3 for every dollar of risk. Now, again, I'm not saying I was making 300%. I'm just saying for every dollar I put up at risk, I was actually making $3. I looked at that and said, well, this is simple. This is what I'm going to do. I'm going to keep doing this strategy until it doesn't work. I'll keep doing it. And I still use that strategy. And one of these days, I'll talk about it in detail, but I have to, I've taught the students, it still works, I still use it. And here it is, 30, 40 years later, and the strategy still works. Write and keep a journal. It's important. You must keep a journal. Go back and look. Go back and look at what you did. Learn from your mistakes. All right? We all make them. The difference between you and a Warren Buffett is not the fact that you're making mistakes. Warren Buffett makes mistakes. It's how you recuperate from them. And as the saying goes, the definition of insanity is doing the same thing over and over again, but expecting different results. Not every strategy will work in every market, but you must have a strategy. And the only way you're going to develop your strategies and fine tune them and hone your skill sets is to write down everything you do. If you're day trading, as soon as you get a break, write down every day trade you've done. I'm not going to beat that horse up anymore, but you guys should have a journal. If you don't have a journal, you're doing yourself a disservice. If you don't have a journal, you're not playing the game. You're not learning the rules. You're not developing a strategy. For my jocks, every football coach, the great Bill Belichick, has what? A playbook. Every sport has a playbook. Why? Those are strategies. Those are plays. Why do coaches call timeouts? Why do at halftime they go in and change strategies? You must have a strategy. You must have a playbook. And the great coaches will go into a game and tell you this particular strategy is not working, and they're going to change. Right? That's you guys. All right? So get your journal, your playbook, keep it, understand it, keep developing it, keep making it better. I wanted to bring up a couple things also. I was looking at some charts. I told you guys what some of the strategies I do to find securities. And one of them is I go and look at what stocks are setting highs, new highs. If I'm looking to short, what stocks are setting new lows and going lower. So one of the things I looked at today as I was going through my list, and there are some stocks that are setting new highs. They're far and few in between. So again, you should check price and volume. Now I got to break this down a little further for you. And I'm choosing my words carefully, so follow it. I only really care about volume when I'm looking to get into a position on a breakout. Let me say it again. I'm only really concerned with volume and an increase in volume when I'm looking to enter a position and I'm looking at the price and volume. It's a way to get into the stock and try and minimize my risk. Once I'm in a stock, I don't care about that volume in that stock anymore. All right? I'll look and see volume on certain breakouts, on certain events. I'll look at volume. But if the stock is going lower off of one share, I'm going to close out my position if it reaches a certain dollar point. If it goes higher off of no volume, I hate to say the word I don't care. So it's not that I don't care, but it doesn't have the importance as when I get in. For me, entry point is much more important than anything else. Let me explain. You go out and you buy a stock right now. Forget a stock. You go out and you buy an asset. Let's say you go out to buy a house for investments. You're going to flip it. So you go out to buy a house. You get the house appraised, and the house appraises for $100,000. You're so confident though that you can buy this house and flip it. You pay 120, no, not even that much, 110 grand for the house. So you overpay for it. The house is going to do what the house does. The house is going to appreciate based upon what's going on in the neighborhood. The fact that you overpaid for it made this a bad investment. Not because the house is not solid, it's because you paid more than the asset's worth. So one of the things I'm trying to get you guys to understand is getting in at the right time and the right price is almost as important as the security itself. Price and volume. Stock breaks out. It breaks out on that price and volume. That's why I want to look to buy. If it breaks out, and again, I'm going through this in the recording I'm going to post from the previous last Wednesday. So if the volume's there, price is there, that's the breakout. What can we expect? When it breaks out, goes up 5%, 10%, 20%, whatever it breaks out to, that new high, the Fibonacci's will kick in. I'm not trying to get into the fibs. I'm not trying, just know this. Let me put it in simple English. There's usually going to be a 50% retracement before it continues to go higher. Let me say it again. If a stock breaks out off of volume and runs for a day, 2 days, 3 days, we expect a pullback of about 50%, maybe a little more, of profit taking, guys taking profits, getting out, pulling back, and then it takes off and runs further. Those are the fibs, those are the volume, that's price. So, once I'm in a stock and I'm in it, and because hopefully I'm right and it's going higher, the volume does not play an important role in me. It really doesn't. If the stock starts to sell off, I don't care if it's 1 share or 10,000 shares, if it sells off and hits my stop or my support level where I'm going to get out, then I'm gone. On the upside, doesn't matter if it's 1 share trades or 100,000 shares or 10 million shares trades. I mean, the only reason why I look at volume once I'm in the stock is because I'm just curious, and it's good to see support come in from institutions with the institutional buying at a higher price than what I paid for it. But once again, the volume is most important to me when I get in. When I enter a stock, for me, is the riskiest time. The reason why when I buy a stock it's the riskiest time is because that's my money. My money out of my pocket has gone in to buy this stock. And if I'm wrong and I get out with a 10% haircut, which is what I'll look to do, if it drops 10% below what I paid for it, I'm gone. Which means if there's my 10% haircut, I'm gone. But that's my money. So if I started out with 10 grand and I took a 10% haircut on that stock, my account now is dropped by $1,000 and now it's only 9 grand. I do this enough times, I'm going to whittle my account down to where I don't have enough money to trade with. I want to get in at the right price. I want to get in at the right time where I have support. And that's why I look for price and volume on the breakout. This is for you trend traders. This is for you momentum traders. This is for you day traders. If you're a long-term investor, again, let's go back to the house. House is worth 100 grand. I'm buying that house as an investment, but I don't ever plan on selling that house. It's in a great location, great school districts, nice appreciation. So I plan on holding that house for the next 30 years. Based on a 3% inflation rate, and in 30 years, that house that I paid 100 grand for could be worth $400,000 or $500,000. If I'm a long-term investor, this is key. If I'm a long-term investor, I'm smiling. If I'm a long-term investor, I don't care if I paid 100 grand for the house or 110 grand for the house. Because I'm buying the house because I know if I hold it long enough, which I plan on doing, the house is going to be worth a lot more than what I paid for it. So I'm not going to mess around with the house and argue with the owner over $10,000 here or there when I think I'm going to take an asset that's worth 100 grand in several years, it's going to be worth $500,000. I'm not going to dick around with that price of 100,000 or 110,000. I hope this is making sense. So again, if you're a long-term investor, a 1%, 2%, 3%, 10% overpay or underpay for a stock is not going to make a difference in your returns if you plan on holding that stock like Warren Buffett does for the next 30, 40 years and never sell it. If you're a short-term trend trader, day trader, then you are really conscious of what price you get in at. So that's what I'm talking about when I talk about price, volume, when to get in, when to get out. Hopefully I had some questions on that, so hopefully I cleared that up a little bit. So what's next for me? What's next for what's going on? I cannot find a stock to buy. I cannot find a stock to short. I'm not a trader, I'm not a day trader, I'm not a short-term trader. And I'm not looking to put a position on to risk $1,000 to make $100. That's not how I work. I'll risk $1,000 to make $1,000. I'll risk $1,000 to make $5,000, but I'm not going to risk $1,000 to make 5 or 10%. And that's what's going on with these stocks. They're in the trading range. Again, if that's what you want to do. So what am I doing? Sometimes the best trade is no trade. Sometimes the best trade is no trade. This is not hitting a baseball where you need to take batting practice. It's not shooting a jump shot. You got to go practice your jump shot. This is not that. What you're looking at right now is your skill set, is your ability to watch the markets and find securities that are going to go up in value, go down in value. So you can do that right now without trading. So I would hone my skill set. But right now, there's no follow through. There's no follow through. So a lot of these stocks, as you know, are in the trading range, which I just talked about. They're in the descending triangle, but there's no follow through to what's going on with these things right now. And that's what makes me nervous in the marketplace. Sometimes the best trade is no trade. Sometimes the best trade is to keep your cash. You know, as the saying used to go, what? Keep your gunpowder dry. All right, so sit on the sidelines and just watch. You cannot lose money on the sidelines. And trust me on this. At some point, I don't know if it's a week from now, a month from now, 2 months from now, 3 months from now, with all this volatility, we will get some investment and trading opportunities. For your long-term investors, you go ahead and nibble. For my short-term traders, trend traders, momentum traders like I am, we're going to get our opportunity. Just be patient. I'm going to confess again my age, but I've been at this for over 30 years. Patience. Trust me on this. You don't have to go out there and force and make trades. You don't have to do that. Just be patient and let the market come to you. Let these trades come to you. Keep watching and looking. Keep your journal, but be patient. So that's what's next for me. Just basically sitting on the sidelines and being patient. That is what's next. The commodities that I've got a fundamental, either buy or sell on, long or short. I'm going to read them to you. Now, again, I'm going to say this to you again. This is on the fundamental side. When I trade commodities, I look for fundamental and technical confirmation. On the fundamental side, I got these for a long. In other words, go long corn, go long the dollar, go long coffee, and go long Kansas City wheat. Fundamentally, the institutions are in here buying all they can get their hands on. All right. So again, the institutions, when I mean institutions, the commercials, the companies that deal in corn, the companies that farmers, Starbucks with coffee, the companies that deal in these underlying commodities, all right, the commercials are buying everything they can get their hands on. So that's why fundamentally I'm long those. On the short side, a couple of currencies, the Aussie dollar, the euro currency, high grade copper, heating oil, and soybean. Now, I mentioned this last week. Soybean and corn, there's usually some type of correlation. I got to be careful with this, but usually in the grains, if the grains are bullish, then they're all bullish. If the grains are bearish, they're all bearish. So you had this divergence between, that's the word I was looking for, divergence between soybean and corn. What happens is this. The farmers look at what's selling. What does the market have a demand for, soybean or corn? Whichever market has a demand for that, whatever has the higher demand, soybean or corn, that farmer is going to plant it. So if soybean prices are at a high level, the farmer is going to say, well, then I'm going to plant soybeans this year. I'm going to grow more soybean than corn because I can make more money on soybean. Well, vicious cycle. Farmer's growing more soybean. Because he's growing more soybean at the high price, the supply of soybeans increased dramatically. Because there's a huge supply, price comes down. Because they're growing more soybeans, they're growing less corn. Supply of corn goes down. Price goes up because demand's still there. All right, that's how the soybeans and corn kind of work. It's not uncommon to get two different signals. One bullish on corn, which I have now, and one bearish on soybean. And if you look, corn's been in a nice little run. It looks like it has a reverse trend, although corn is down the first couple of days of this week, and soybean is actually down. So again, these are my commodities. These are giving me trading opportunities. I didn't do anything this week on those. And just a quick reminder again, I am still short the market. So we're still short the market right at these levels. The stock market itself does not discriminate. Let me explain what I mean by that. When you go to place your trade, when you go to buy your security, the stock market doesn't care if you're black, white, Asian, Latino. They don't care. The only thing they care about is how green is your money. The other thing that's interesting about this is, and I know you guys all hear it, somebody has a secret trading platform that's making money. Somebody's got these signals that is better than anybody else. This guy's making more money than somebody else. He knows what the market's doing. This one doesn't. And you think that there's some insider information that's going on. It's not that way. There is no magical black box. There is nothing right there. The market does not look and say, oh, Mike Milligan, who's a black man, owns Google, so therefore we're going to have Google stock price go down for Mike Milligan. But for the other people who we like, who aren't Mike Milligan, we're going to have the price of Google stock go up. It doesn't work that way. It doesn't. This is a level playing field. This is the reason why, this is what pulled me to Wall Street, 40 years ago. It's what keeps me here, is that it doesn't matter what color or race you are. It doesn't matter. It matters your ability to actually make money in the market. Now, the one disadvantage that we might find with minorities is that a lot of us have had built into our heads, into our psychic, that we're not smart enough to make money in the marketplace, or you're not smart enough, or you don't know the right people, or you don't know this, or you don't know that. It can all be learned. You just have to apply yourself. All right. So, and what's funny about the wealth in the stock market, The wealth in the stock market is for anybody that's willing to invest in the stock market. All right. For my minorities that are watching this, the challenge you have is you have to overcome the stereotypes. You have to overcome the stigmas that's in your own family. Even myself, my own family members. I remember like it was yesterday when I was a younger man. Don't go to work on Wall Street. You don't know what you're doing. You're going to lose money. It's not a career. You can't make money in stocks. My uncle so-and-so lost all of his money in stocks. Don't mess with stocks. It's like gambling. You might as well go to Atlantic City and play. I mean, this is all the things I was hearing. The reason why I bring that up is I know that some of you guys are hearing this. It's nothing but speculation. You might as well go to Vegas. You might as well just roll craps. That's why a lot of younger people are buying JCPenney. That's why they're buying JCPenney. They're looking at Sears. They're looking at all these because they view it as a crapshoot. And those companies right now are crapshoots. Yes, you can lose all your money in the market. Yes, but you can lose all your money in anything if you don't know what you're doing. So learn, grow, understand what you're doing, write your journal. Just as I close again, no one knows what's going to happen. We wake up every morning to watch the market to see. I don't know what catalyst is going to actually cause this market to crack. I don't know if the market's already started to crack. As I said, I'm short. My short position is down a little bit. In other words, when I put the short on, the market ran. So I'm right around, I guess we're close to break even on my short positions. But again, this was not a short-term trade. I wasn't trading the market. I believe that there's going to be a crack. I just don't know when. So I'm not trying to time it. So this short position will stay on unless it goes against me at a certain percentage point, which is a 10% loss, and I'll cut my losses. But other than that, I'm short the market. That's actually where I'm more comfortable at being short than being long. I'm not saying I'm right. I'm not saying the market's going down the next day or two. All I'm saying is that's where I'm at. I'm having a hard time finding things to buy on the short term. There's no follow through. All the profits are at the opening. All the losses at the opening, and then there's not much movement after that. And I'm not going to trade for 25 cents, a dollar. That's not who I am. That's not what I'm looking to do. I'm going to wrap this up, but say it again. A couple of key points. One, if you take nothing away that you took from me today, one, a journal. Write everything down. I'm telling you, write it down. Go back and review it. Go back and review all your old trades, all what worked, what didn't work. The ones that didn't work, don't run from them. You'll learn more from your mistakes than you will from your winners. I learned more from my big losses than I ever learned from my big wins. And my big wins probably would not have come had I not studied why I was making money on those smaller wins. Because when I found out why I was making money on the smaller wins, I looked and said, if I do nothing but increase my size, I should increase my profit. All right? And that's exactly what happened. So study your trades. Study them hard. Now, let me see. I got a question that just came up. If we are buying equities, would it matter if we are buying based on valuations anymore since the Fed's buying individual bonds, really high liquidity? I think I understand the question. So a couple things. Let me just look at it again. So a couple things really quick. The Fed's not only buying individual bonds, the Fed is actually buying ETFs too, bond ETFs. The Fed is out there pumping money into the system left and right. All right, that's what the Fed's doing. In this market environment, so we haven't gone into this yet a lot, but so let me dig into this real quick right now. I'm just checking my time. Okay, cool. Let me dig into this real quick. In general, when it comes to investing, Wall Street typically will lump into one or two categories: growth or value. Value is when you buy an asset at a discount to its appraised value. Going back to my $100,000 house. If you're a value investor, you're only willing to pay $80,000, $75,000 or less for that house that appraised for $100,000. Your whole thought process is, if I can buy an asset at its discount, no matter what the market does, at some point, the market's going to realize that value and the stock price is going to move up to where that value is. All right? That's Warren Buffett. So as long as that value's there, as long as everything fundamentally is going right with the business, and by the way, if you hold it long enough, you brought at a discount, that business might still be growing, which means that disparity, that gap could get even bigger, which is cool. That's a value investor. A growth investor is going to pay $100,000 for a house that's worth $100,000 because he believes that neighborhood where that house is, houses appreciated at 10% for the last 5 years. He believes it's going to appreciate another 10%. So he thinks the house he bought for $100,000 today is going to be worth $110,000 a year from now, and $121,000 2 years from now. That's a growth investor. In this environment that we're in now, the way the market's trading, what's going on with the coronavirus, you are in a value market. All right? Now, I got to be careful here. And the reason being is, I'm not talking about the price of the stock dropping. The reason why I call it value is, if the price drops because the value of the business drops, then that's not a value investment. But if the business is doing well and low tide comes in, and the business is still doing well, but low tide has come in, which brings all ships down, which means that that business that's still doing well, you can buy at 20 or 30% discount to that value. Those are the ones you want to buy. That is Warren Buffett to a T. So you'll find most of your value investments in a bearish market. Because in this in a bearish market, a lot of individuals don't want to own stock. The demand is not there. And because there's no demand, the price starts to drop. That's where you start to find value. In a bullish market, in an up market, you won't find much value. You'll find growth. And that's where the growth investors take in. There's no right or wrong. In some environments, growth works better than value. In some environments, value works better than growth. But there's no right or wrong. It's not like a growth investor is going to make so much more money than a value investor, or a value investor is going to make more than growth. It depends on the environment and what situation you're in. So in this environment, you're going to find more value than growth. The only challenge you have as a value investor is, I don't know when, and you don't know when, the market's going to realize that value. You brought the company, the value's still there, business is going well, fundamentals are there, the revenue's still growing, earnings are still growing, but the stock price has dropped because we're in a bearish market. I don't know when and how long it's going to take before that stock price reflects in what goes on here. That's the reason why Warren Buffett is a long-term holder. He has no control over how the value is going to get there. Now, if this was a house and you brought a handyman special, we could put some sweat equity in there and increase that value within 30, 60 days and put it right back on the market. We don't have that ability to do that with publicly traded stocks. All that to say this: if you're a value investor in this environment, you can find value, but be a long-term holder of the value. What do I mean by that? Company could still be doing well and revenue growing, stock prices dropping because we're in a bearish market and the market's headed lower and the economy is not doing well, and your company could still be doing well. Go back on my Instagram account and look. I talked about Apple in 2008. And in Apple, in the middle of that great recession of 2008, Apple set a record for revenue in 2008 and 2009. Stock price was down here with the market. And as soon as we came out of that in 2009, Apple took off and outperformed the market. I've already posted on Instagram. Take a look at that. That's what you're looking at when you become a value investor. That's your mentality. So a growth stock can become a value stock if the price drops, even though the value still there and it's still growing. I'm trying to think of one off the top of my head, and Amazon's at an all-time high, so you're not going to get that. Google's at an all-time high. So is Microsoft. The FANGs. They're all at all-time highs right now, off of no volume and light trading. I don't know how strong they're going to be, but that's what you're looking for. You're looking for stocks that have that. In last week's recording, which I'm still working on, let me review this. Last week's recording, last week's Wall Street Wednesday. As you guys know, I record these things. I'm going to repost this on Instagram and record it. But then when I actually post it on my YouTube channel, which is, you can follow my YouTube channel, Professor Milligan, I add to it. So I add to it based on the conversations that we're having right now. So last week's, I have a couple of actual illustrations in there and some other things. Make sure you take a look at those YouTube channels and those when I post them, those YouTube videos. Last week's, there's a lot of powerful information in there that I actually give illustrations to. That's what's taken me so long. But once I do post it, I'll let you guys know, and you definitely want to check it out. Even if you just go to the last, I don't know if it's going to be 15 or 20 minutes of that video, you're going to see that I posted a lot. And I'm trying to figure out how to make these videos shorter and more compact to give you guys the same information. I'll figure it out. All right, so that was that. Let me see. I don't think I have anything else to add. You can find some opportunities in the IPO market. You can also find some opportunities in the secondary market, the SPO, secondary public offerings. So I'll go into more detail, but there are some opportunities that you can find, short-term trading opportunities in the IPO market and the secondary public offering market when they come public. We'll spend some time on that. Real quick recap again. We talked about the market. We talked about how the market's in the trading range and a number of stocks are in the trading range, or we have what we call a descending triangle. So a lot of these securities are sitting right there at support. So make sure you have that. I have not covered any option strategies yet. And the reason why I haven't covered option strategies, and a lot of times people get confused with this, I'm checking my time because last time it shut off on me. I'm checking, I haven't gone into option strategies yet because options are a tool, and the option is going to perform based upon the underlying asset. If I'm looking to make money on the long side by buying a security, and so instead of buying the actual security, I decide to buy the option. If I'm a terrible stock picker, the option is just going to make my money loss even worse. So one of the things I keep emphasizing before we start getting into options and using options and different option strategy, you have to have the ability to pick stocks or pick a security going up or going down in value. Your ability to isolate stocks and determine if they're going up or down in value and over what time frame will improve your ability to make money in options. I've had clients, I've had students who, because they heard how much money you can make in options, decide to go trade options, and they're making some of the worst stock picks in the world. So imagine you decide that you want to trade options, so instead of you actually buying JCPenney stock a year ago, you decided to buy the options, and you were trading the options. Well, I'm telling you right now, you lost all your money if you were trading the options. If you were playing JCPenney to be bullish, which a lot of people are buying JCPenney stock, I don't know why. That's what I wanted to say there. My option strategies themselves are all based upon the underlying stock. Sonny, I see you asking me the question about some other channels and whatnot, and I'm smiling because, Sonny, I remember that you were in my class one semester when I actually put on the board one of my option strategies. It was the last week of the semester, and I put on some option strategies, and I said to the class as well as you, if I asked the class, are you bullish or bearish on the market? And half the class was bullish, half was bearish. So I said, well, here's the position I would put on. Here's the trade I would put on if I was bullish to the market. And here's the trade I would put on if I'm bearish. I said, so if the bulls win, we'll see if the bears win. Long story short, the market ran those last 2 weeks of the semester. It was a fall semester. And that position, if I remember correctly, either doubled or tripled in price before expiration. You know, some of you guys already do know some of this strategies. I will teach it to. Let's see what else I got here. Tomorrow is GDP, unemployment reports. Yeah, the whole shebang starting to come out. The data's coming out. Remember this, as the data comes out. Again, I'm just checking my time. Okay. As the data comes out, if you're looking at this data, before the data comes out, you got to look and see what is Wall Street expecting. What are they looking for? And here's the deal. If Wall Street's looking for a particular number, and the number comes in better than that, expect the market to run. If the number comes in worse than what they're expecting, especially on unemployment and GDP, if the number comes in worse, expect the market to pull back. And also what's interesting about the GDP, you know, they might even revise the previous quarter's GDP, so we'll have to look and see. But this is all interesting data. I guess the thing I'm going to say to you is this. It's not the data itself, it's what Wall Street's expecting the data to be, what the number to be. Wall Street reacts to surprises. If the number comes in exactly where Wall Street's expecting it, then the market's not going to have a reaction to it. And the market's already priced in those numbers that Wall Street's expecting. If the numbers come in better, what that means is that Wall Street was wrong and that the numbers are better. They're going to reprice those into the model, and you'll see the market go up. If the numbers are worse than what Wall Street expects, it's a surprise. It's going to shock them. It's going to shock the market, and the market's going to go down. This is the reason why you'll hear me talk about hedging. Hedging your positions is a way to reduce price shock. And price shock is nothing more than the unexpected, but huge unexpected. A price shock is that something that could actually cost the market or the stock to drop 2, 3, 5, 10%, 20% in a short period of time, a day or two. That's price shock. Hedging prevents you against price shock. Auto insurance protects you against price shock, your car being totaled. Some of you, including myself, have car insurance, had a minor scratch on the car, a little minor fender bender, and didn't even report it to the insurance because it wasn't worth your time, the time or the money. But if your car was totaled, you reported it. Why? That was price shock. Instead of it being a couple of $100 now, you're looking at a couple of grand, 20 grand, 30 grand, 50, depending on the car, it could be 100 grand. That's price shock. Wow, we covered a lot today. I want to thank you all for coming. This recording will be posted on Instagram. And again, I will go back and be patient with me, but I'll add some comments to it, and I'll let you know when those are coming in that supports everything we talked about. So once again, I want to thank you guys for showing up and coming. I do appreciate you. Again, my goal is for all you guys to make as much money as you can in the market, make as much as you can, become that 1%, become wealthy, and pass that wealth on to your children, generational wealth, and enjoy a great lifestyle. So with that said, once again, thank you to Wall Street Wednesday. I'm here every Wednesday on Instagram Live. You can come see me. I'll post my videos on my YouTube channel. You can go to my YouTube channel, which is also Professor Milligan. And anything I have for you will be there. And during the week, as I start, if I see more, like I said, if I see more trades and more things to trade, I'll come on live and tell you some of the things I'm doing. Right now, I'm telling you, you're seeing what I'm doing. I'm basically doing nothing. I just don't see it right now. All right, with that, signing out, Professor Milligan.